Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. The show is brought to you today by Lumit. Hey, they make financing, application, and servicing very easy. They're located all across the country. Most notably, think of them for senior housing, for medical properties, for residential multifamily financing. Check them out at lumit.com. Well, we have another great show for you today. Every year now for, how many is it, 24 years, I think. No, 9 years. Seyfarths Shaw, now known as Seyfarth, puts out a market sentiment. We're going to talk about their 2024 Real Estate Market Sentiment Survey and what the participants around the country are thinking about commercial real estate moving forward. You know, it's kind of interesting. What we think about, we can become sometimes, right? We can create our own market by our sentiment. Please welcome my guest is Ron Gart, and he's a partner with Seyfarth, and he's joining us on video. Ron, good to see you again, sir.
Morning. How you doing?
Good. Well, for you guys on that video, this is what the report looks like, and it'll be available on our website. There'll be a link to the actual survey, and you also can get it at seyfarthshaw.com. And let's get into it, Ron. First of all, overall, in this sentiment, well, I want to know kind of what the sentiment was, but before you get there, tell our audience how you do this survey, when it was finished, and how it's done.
Yeah, context I think is critical, especially for this year. We generally go out in the second or third week of January, try to collect all of our results in a 2 to 3 week time period. So the first week of February we're done. And then we compile the information, and then we try to analyze the information. In the meantime, probably took us about a month to put the questions together. We have a team that works on putting the questions together, and we wrote some out, try to throw some historical questions at the respondents as well, so we can watch it over a period of time. So together, we come up with this survey, and I think we sent it out to about 2,500 folks nationally. Seyfarth's got offices around the country, and frankly, outside the United States. But the bottom line is we try to hit all of our markets that are domestic, and then try to get the respondents to respond within that short window. And this year, it's critical because the Fed announcement or statement that they expect to see at least 3 downward adjustments occurred in December, and that was before, and the survey went out, and the survey results came in before the new CPI numbers came out, and there were a change of foot, if you will, in terms of the Fed approach.
Great. And the market participants that you survey, how would you describe them? They're
commercial real estate professionals.
Okay.
So they're brokers, lenders, developers, consultants. There may be some lawyers in there, frankly, if they're on our list of folks that we've dealt with in the past. Absolutely.
And across all property types and sectors, right?
Absolutely.
Okay. Well, great. Well, Ron, overall, what is the sentiment, and has it adjusted from last year?
Well, so the first thing you notice is a lot more optimism into 24 from 23. And in fact, we asked the same question in 23, and we had about 69% of the folks said, hey, we expect to see a year of opportunity versus retrenchment. In 24, that became 83%. So a substantial increase in the optimism. And we'll talk more in terms of some of the other results, but you can sort of understand why, if there's an expectation of downward adjustment in interest rates, an expectation that distressed assets that everybody expected would be there in 23 and didn't see are coming to fruition in 24. A presidential election year with some expectation of, put stability in quotes, at least as relates to the economic market. So there are many more reasons to consider, plus, frankly, coming off of 23 being as bad as it was, that 24 would be a year of optimism and opportunity, or perceived opportunity by the respondents.
Right. And you mentioned the election year. What is the sentiment of those surveyed about, does it matter who gets elected And do they have a favorite candidate that they think will help commercial real estate?
You had to go there, didn't you?
You brought it up.
Yeah, so the answer is that not much of an expectation in 24, frankly. Some expectation, but it's moderate at best in terms of there being a consequence in commercial real estate as a result of the election. Going to your second question, there's a clear preference for former President Trump at, I think it was 47% over President Biden as to who would be better for the commercial real estate industry. And you can analyze that any number of ways. But the question is posed in terms of being better for commercial real estate. And you've got analysis of, well, the respondents could skew Republican. That'd be a political answer. On the non-political answer, both former President Trump and Republicans generally have a perception of being in favor of tax cuts and deregulation, and I think there was some of that in the Trump administration. And those go to the very heart of the real estate industry, tax cuts and deregulation. And then in the face of the Infrastructure Act and the very good economy that we have, but for, again, commercial real estate. I'll come back to that in just half a second. Through the Biden administration, you've got the high interest rates. You've had a very rough 2023. And there could be a hope, if not expectation, that with a change in administration, there'll be more opportunities for commercial real estate with lower interest rates as well. And perhaps the Biden administration is getting some blame for the Fed's activity on the interest rate front.
And what was the overall sentiment of those surveyed about transaction volume and their activity buying and selling and transacting?
Well, we didn't ask the question in terms of percentage, are you going to be, but with a combination of the optimism, a combination of, in terms of our questions, we asked about whether they would invest in distressed debt. And while the percentage was about the same as in 2023, we said they were interested in distressed debt. The reality is that there was not much in the way of distressed debt that came on the marketplace in 23, but there is an expectation, and we're seeing it already in 24. So there's an expectation with the interest rates being reduced on some level that distressed debts opportunities will be more prevalent. Some, and as we'll get to it later on, and some interest in conversion of office to non-office uses. You've got a number of factors that lead towards the hope and expectation that there will be more in the way of transactions, with the one impediment that was one major impediment that was identified. And we asked the question of the factors that they're going to consider in going forward, what's the most important? And that was pricing. And I think it's critical to understand what we saw in 23, again, going into 24, is the buy or the bid-ask spread being what it was in 23. The very few transactions that occurred on that basis, let alone the availability of financing, capital sitting on the sidelines and not jumping in. But we constantly heard about pricing being an issue, and the survey shows that. I think it was 75, there was 1 second, I think it's 76% of the folks thought that pricing of assets was the critical criterion for investing in 2024. And now with some transactions in the fourth quarter of 23 and the first quarter of 24, you're starting to see some pricing stability come back into the marketplace. So going all towards the point of that's why they're optimistic.
Yeah, well, that makes sense. And we've seen the same thing as brokers selling all types of properties in the Southeast U.S. It was like January hit, and a lot of people were more optimistic, and a lot of sellers kind of, all right, we're back to more historic normal rates, so we understand pricing, and buyers getting more active. But I think there's different opinions of what the rates might be. And of course, no one really knows. But on your survey, what kind of interest rate changes were folks expecting?
Well, again, context is important. So the Fed makes this indication in December that they're going to have 3 rate cuts. we go out to the marketplace and say, okay, how many rate cuts do you think that we're going to see? And where we saw optimism, generally in terms of opportunity going forward, I'll say there was realism on this issue, because the vast majority said that they did not expect to see 3 downward adjustments. And of course, since the CPI numbers have since come out, everyone's saying delay in terms of those rate cuts. And whereas a lot of economists at the beginning of the year were saying you may see 5, 6 rate cuts, I don't know that there are all that many saying that today. Our respondents saw that in the 3rd week or so of January, 4th week of January, and said, okay, we don't see that many adjustments. And in fact, we're going to see close to 50% or less in terms of our percentages, and specifically only those who thought there were going to be more than 50 basis points, 23%. The balance thought less than 50 basis points in terms of an adjustment, which is substantial relative to where they were, again, in context from what they heard from the Feds. So that, from our perspective, my perspective in particular, that's pretty telling. We've got a set of folks out there that weren't persuaded by, we'll say, the media and arguably a Fed announcement. They looked at what was on the marketplace, and they said, okay, what we see realistically going forward is a slower, lower downward adjustment. And our third question, I'm going to suggest to you that that's generally speaking acceptable to the marketplace. In that, whereas for some percentages, so 51% of our respondents said that they expected a 26 to 50 basis point downward adjustment. The next question was, what do you think is necessary for transactions? And a good 49% said 51 to 100 basis points, and 30% said 50 basis points or less. So we would suggest to you, that if there are fewer than 3, if you will, assuming each one being 25 basis points, that's generally acceptable to get our respondents at least motivated on the financing side to get out there and transact.
Yeah, well, that's good news, and I hope that's what we're starting to see at the beginning of the year here. Of course, work from home and work from office has impacted office properties in a big way, but also just the way businesses operate. When you ask questions about that, did your respondents think it had really impacted their business, and what did they expect for number of days in the office on average moving forward?
So 2 questions, 2 responses. And we've tracked this now for a couple of years. Generally speaking, I think the survey respondents would tell you, or the results tell us, that folks are more sanguine about people working from home, not necessarily on a 100% basis. So we'll call it hybrid. So some element being in the office at some point during the week, so that no longer profits were never a real issue. Loyalty was an issue, sort of, and those numbers stayed about the same. It was the culture that was always the biggest concern, and that concern reduced substantially this year. And since if the culture is not going to be adversely impacted or considered as being as adversely impacted, then our analysis is people are, after all these years now, are becoming more sanguine about letting people work remotely. Now, having said that, the respondents, by and large, and I think the percentage was 49%, if I recall correctly, said that they would be in the office between 4 and 5 days. So notwithstanding that they're letting or considering their employees being in the office fewer than 4 or 5 days, it's 59% said that they're in the office for that period of time. So again, if you're in management, and most of these folks are in management, at least based on our analysis of who our respondents are, then what they're saying is, well, we're going to be in the office most of the week. It's acceptable for our employees not to be as often as we are. And that goes to that whole point about accepting the marketplace for what it is. And we know that every now and then, and frankly, probably every August, or every July into August, there's a statement, well, come September, we're going to require our employees to come in to the office 5 days a week. And it doesn't happen, or rarely happen. And I think that's what we're also seeing in our commercial real estate market.
Yeah. We're talking with Ron Gart, a partner with Seyfarth, about their 2024 real estate market sentiment survey. And, it's good that people are optimistic, but there's always the question about, hey, what concerns you moving forward? What do you see there?
Well, the biggest concerns are still interest rates. And that was at 70%, far and above. The availability of debt financing at 45%. Construction costs being what they are at 37%. And taking those into account, then you, together with the concept of stability in finance, in pricing, those are the areas I think where people are focusing. But the interesting part of the stories are twofold. One is last year recession was a big issue. The vast majority of our respondents either thought that we were in a recession or would have a recession in 23. We didn't. In terms of a global economy or United States economy, the commercial real estate industry, however, obviously was very negatively impacted. And then the second point, which is interesting, property insurance, the cost of property insurance premiums. While we put it on the list and it got a 30% response, we would not be surprised if some of the interest rates are adjusted downward this year. The property insurance premiums will be in the top 3 next year. We're just hearing anecdotally how important this issue is in state after state, locale after locale, both availability of insurance and then the cost of insurance, that might very well move up, if you will, to the top 3. Construction costs have been up high throughout the COVID period and thereafter. And we don't know about debt financing yet, but interest rates come down. The hope and expectation is there'll be more availability. So property insurance in 2025 might be one of the top 3, if not 1, 2.
Yeah, that makes sense. And, a lot of folks even look forward to these downturns to try to buy some distressed opportunities. What did your respondents say there, and how does it compare to, say, a year ago?
So what we're looking at now, there's a lot more interest in distress. 74% of our respondents said they'd be looking at distress. Last year, it was closer to 50% that were looking at distress. And again, from our analysis, in 2020, you got 2 things. In 2023, assuming 50% said, hey, we're going to look at distressed assets. Well, they weren't there last year. So you could say, well, there's some pent up, I don't know if it's demand, but certainly interest in distressed assets. That's number one. Number two, we are starting to see distressed assets come to the marketplace, or we did at the very end of the fourth quarter and so far the first quarter of 2024. So you've got the availability of distressed assets, so that it's tangible. Something is out there. So if you've got value-oriented folks looking at real estate and it's available, it appears to be within a certain distance to actually pursue it. So we expect that interest is there, that it will be realized this year. There's a lot of capital, as we all know, on the sidelines. And now, once we get to a better understanding of pricing, which you get by having some of these distressed assets move, then you've got the factors to go out and get a deal, assuming for the moment that you have the capital to do so. And so you still have that. Are you going to finance it? You're not going to finance it. That's still out there. But in terms of availability of assets, yeah, there's a real interest on distressed assets in 2024.
And Ron, what did your respondents say about liquidity, about the dry powder out there, and the source of their equity moving forward?
Well, there's no doubt about it. And private equity was the number one source. Institutional investors was pushed back a little bit, and there's some discussion that they're sitting on the sidelines because they're not value-oriented. And if you're considering distressed assets, if you're considering opportunities to move quickly, you may not be considering institutional investors as much as you would private equity, who can go out there and effectuate a deal and perhaps faster.
Right. And one of the things I think you've had this question on your survey for a couple of years is about AI and the impact there, and are your respondents using it? Has that changed this year? What's the trend there?
Yeah, well, so it's interesting on AI. There's 50% said that they have already implemented or will implement AI. Some would say, well, gee, there's a long way to go. The reality is, real estate is a conservative market generally. So now you've got to decide where AI fits. And the focus so far has been on design, development, some prop tech data, which you can say that's AI. There's been a focus on prop tech for, 7-8 years at least. And so the brokerage firms and major developers have been trying to collect data, and now so is that AI or is it not AI? It depends on how they use it. Going forward, using that data will be through AI. Law firms are able to focus on AI, not merely on the heightened cases you may have heard about research, but also in terms of contract administration, being able to take contracts and quickly identify phrases, clauses that are applicable to a particular deal. So the hope here, and certainly the expectation, is that AI will become much more prevalent. And I think the 50% saying that they're already using it or plan to use it again next year will be much higher as they realize, a definition of what AI is, and B, actual application.
Yeah. Well, Ron, as you were involved in this survey and you've been looking at the results and talking about it, what jumps out to you as a trend that we may want to think about?
I think we've met now, I think 5 or 6 years, Michael, and I say that the fundamentals are the critical element for commercial real estate, and that's still the bottom line. And, interest rates, pricing, the nuts and bolts of real estate, and I do think that we've gotten well, you can say it's on the one hand, commercial real estate is a sort of a conservative sector. There are a lot of entrepreneurs, so they are pursuing data. They just didn't know it was AI. Now it's AI. They are pursuing conversions, which we didn't really discuss. We can talk about it in a second. They are trying to find ways, especially after a year like 2023, where people went backwards or just stayed still mostly, that to find opportunities for 24 and 25 to get their money out and make the returns that they and frankly their investors expect.
Yeah. Well, that's good news. And that's a great survey, Ron, and thank you for doing it. And thanks for covering it for our audience around the country.
Happy to do so. Thank you for the invitation.
All right. And thank you for joining us around the country. Hey, please pay it forward. Please share this show with others on your social media. Connect with us if you like. If you'd like to get a copy of the survey, you can get it at creshow.com. At this show, there'll be a link there, or at seyfarthshaw.com. You can get the survey. So till next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bullet Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. And by Lument. For senior housing, healthcare, and multifamily financing, visit lument.com. For more podcasts and videos, subscribe and visit creshow.com.